Hello and welcome to a brand new edition of Smart Money. Now, with the RBI hiking the repo rates at which banks borrow money, high inflation and tighter liquidity conditions have reduced the steepness of the yield curve. So this, according to many experts, is a good time to invest in fixed income as part of your portfolio. Attractive yields, a wide variety of schemes, and tax benefits for long-term holdings are just some of the benefits. Joining us today is Rahul Goswami, the CIO of Fixed Income at ICICI Prudential Mutual Fund. He, in fact, manages a fixed income portfolio, which I guess is by far the largest in the country. Rahul, thanks a lot for joining me on the show. I first want to start by understanding how the fixed income landscape has changed over the past 1 year, and then we'll come to whether it's a good investment opportunity for our viewers.
Thank you, Sonia, and thank you, CNBC, for calling ICICI Prudential. So what you said is absolutely correct that the things have changed pretty rapidly in last, say, 6 months, and especially if you compare it to last 1 year. After inflation spike persisted and the inflation no longer was seen to be like say temporary or for the time being, but the inflationary pressures have sustained and one or the other thing kept on going bad, and we have seen like say globally central banks raising rates aggressively, and RBI in fact has in last 6 months raised the policy repo rate by almost 190 basis points. And market yields have gone up sharply by almost 300 to 400 basis points as far as the very shorter end of the curve is concerned. On the fund side also, we have seen good participation coming up from investors who are now looking to benefit from higher interest rates, courtesy RBI hiking policy rates and liquidity getting tighter, like say 3-month T-bill, which was yielding about a year back of close to 3.25%, is now yielding close to 6.4%. And that is the similar case with the bank CDs, where the 1-year CD rates have gone up by 300 to 325 basis points from say close to 4% levels to close to 7.5, 7.6% levels of the good high-grade AAA banks are concerned. So we are seeing renewed interest from the investors as they are also seeing that the portfolio yields have gone up across the curve, and that's what is consistent with our view what we were having for quite some time.
Okay. So Rahul, the portfolio, you're saying you're seeing a lot of keen interest from investors in the fixed income market, but I wanted to understand from you, has the rise in interest rates been proportionate across the yield curve, and which segment of the yield curve has, for example, been most impacted from the rate hikes?
So, Sonia, what has happened in, like, say, the 10-year bond yield, which was about, say, a year back of about close to 6.5%, that has gone up by almost 100 basis points, whereas the shorter end of the yield curve, which is directly or more meaningfully impacted by the RBI policy rate actions, so that the shorter end of the curve has moved up by 300 to 350 basis points in the up to 1 year maturity segment. And that has seen the biggest benefit coming from for the investors who are invested in the low duration category or very short term maturity funds category. Apart from that, the investors who have benefited and have not lost money because of policy rate hikes are the investors who are invested in floating rate instruments. And as we understand, we believe that it is a extremely, rather not at all wise thing to borrow in a floating rate structure in a rising interest rate scenario, and in a scenario where inflation has turned out to be much more persistent and not temporary in the nature. And we expect that the floating rate investors and the low duration category investors or investors who are invested in low maturity funds are likely to benefit most in times to come, with interest rates more expected to rise in the near to medium term.
So you're saying that interest rates are going to rise further. Is that your expectation, or do you think that they've peaked already? Because there is a mid-quarter review, or rather an out-of-turn review of the RBI coming up next week, right, on the 3rd of November. But there's no rate hike expected there. And the view from across the globe as well is that in this FOMC US Fed meet that happens next week on the 1st of November, there could be a 75 basis points rate hike. But then post that, rate hikes perhaps have peaked. So from an investor standpoint, do you think we've peaked in terms of the maximum amount of rate hikes?
So, Sonia, what the market chatter and the market, the curve is pricing in is about 150 to 175 basis points for the rate hike by US Fed in next, say, 2 to 4 months, or latest by March of 2023. And in light of that, apart from that, other central banks are also likely to have a different magnitude of rate, like say ECB raised rates by 75 basis point, and they have said it will be data dependent going forward. But in India, we see that with challenges such as elevated current account deficit and relatively high fiscal deficit of close to 6.5%. We believe there is possibility that inflation may remains higher than the RBI threshold level of 6% in next, say, 2 to 4 quarters. And in light of that, we believe there is possibility of 75 to 100 basis points for the rate increase in case of India as well in next, say, 1 or 2 quarters. But we cannot comment on what the 3rd of November, the out-of-turn RBI monetary policy that is being conducted, that primarily looks like is the MPC being called to discuss or deliberate the reply to the government, which was required that the inflation number has reached the RBI threshold level for last, say, 3 quarters consecutively.
So, okay, let's try and understand from a layman's point of view, right? For an investor who perhaps has never looked at the fixed income market, is now interested because of the way the interest rates are moving up. Why is the fixed income market attractive today, and why should I invest in it with, say, a few months or a year horizon?
Yeah, so if you compare it to the savings deposit rate, which is probably close to 3% for best of the banks in the country, and against that you get the very low risk category or very high credit risk and very low interest rate risk category funds, which can be as conservative as an overnight fund, which potentially would be yielding close to 6%, and the liquid fund, the money market funds, the ultra short category funds, and the low duration fund, where the YTMs have gone up beyond, say, 6.5% and even close to 7.5%, 7.25% to 7.5% for low duration and floating rate funds category. So I think there is a great merit in keeping money invested in mutual funds and try to take benefit of these elevated interest rates. What we believe is that the rates may remain elevated owing to uncertainty globally on account of whether be it Russia, Ukraine, or other things propping up or coming up, or that the inflation may remain close to 6% or higher than RBI threshold for India, with currency pressure continuing to persist in another, say, 4 to 6 quarters, if not more, owing to high current account deficit and high fiscal deficit numbers. So we believe that inflation may remain high, and we, in all certainty, will see probably 75 to 100 basis points further increase in the RBI policy rates. And we think that low duration funds and the floating rate funds and the very low maturity funds are likely to be great asset for investors instead of keeping money in a dormant account at very low rewarding rates.
Okay, all right. Well, let's do one thing. Now it's established that with interest rates going higher, fixed income as a part of your portfolio is perhaps a great idea. How much should you put into fixed income, and what are the different kind of fixed income opportunities that we have? We're going to talk about all of that on the other side of the break. Don't go anywhere. Smart Money will be back in just a bit. Welcome back. You're still with us on Smart Money, and today we're discussing about fixed income and why it's a great time to add fixed income to your portfolio given the rising interest rates. Rahul Goswami, the CIO of Fixed Income at ICICI Prudential Mutual Fund, is with us. Rahul, before the break, of course, we were discussing the pros and cons of investing in fixed income. But now tell us, which fixed income strategy do you find the most attractive for investors right now?
Yeah, thanks, Sonia. So we believe that low duration funds and the low maturity funds, apart from that, that looks to be the best in case of rising interest rate scenario. And one fact I may want to, mention is that the difference between one-year T-bill and the 10-year G-Sec, which was close to 300 basis points a year back, is now contracted to almost 60 basis points. So we believe that this spread is unsustainably low, spread of 50 to 60 basis points, and at some point of time, this spread will again widen. And we believe that high interest rates or these interest rates at current levels are likely to persist and may inch up higher only. So we believe that the risk is on the higher maturity, higher duration segment. But at the same time, we believe that up to in the low duration and for funds like, say, ICICI Prudential Low Duration, ICICI Prudential Floating Rate Fund, like, say, ICICI Prudential Short Term Plan, or the All Seasons Bond Fund are great funds to invest in for having a safe and experience which will be in line with the investors' expectation and requirements on their pure savings investment requirement funds.
Okay, so you said low duration funds, floating rate bond funds, perhaps some good options to invest into. For someone who is maybe in a younger category, about 30 to 40, or even younger, maybe 20 to 30, and wants to take a bit of a fixed income exposure, what is the split? How much should one have in equities? How much should one have in fixed income? What's the best way to approach it, given the rising interest rate scenario?
Yeah, so I think they have different, investors have different risk appetites, and depending on their age and the investment requirement, they should consult their financial advisor. But broadly, we think that from that perspective, the balance funds are the best approach to look at, including like our ICICI Prudential Balance Advantage Fund. That's a great fund to have a more stable return over a period of time, and but frankly, with high interest rates which are prevailing right now and are further expected to rise, we believe that fixed income offers a much better opportunity than the other asset classes to invest and have the risk-adjusted return, which will be much better than the other asset classes.
Okay, so fixed income is a better asset class at this point. Got that. Which are the other strategies, Rahul, according to you, that you would recommend in addition to floating rate bond funds? I mean, you spoke about short duration, floating rate bond funds, but which are the other strategies that you would recommend?
On the fixed income, the other important strategy that we run pure on models is the All Seasons Bond Fund, which is being run purely on model basis and on factors which actually impact the interest rates with the lag. And so there we believe that for a long-term investor in fixed income exposure, I think they must be invested in ICICI Prudential All Seasons Bond Fund. Apart from that, we believe that the short-term plan, ICICI Prudential short-term plan, also offers a great opportunity because they are, apart from low duration and floating rate category, here the fund manager actually takes the call to maneuver the duration so that it tries to take the optimum benefit of the market movement and the inefficiencies in the market. So these two funds, apart from that, and apart from that, if the investor is genuinely looking at, has a stable investment horizon, then apart from these two funds is the credit risk fund, which basically caters to, which typically comes with relatively higher credit risk, but not exactly it's a very high credit risk. It's a credit risk fund, which obviously comes with some risk element on the credit side, but it offers a great opportunity where the portfolio yields are close to 8.5% as we speak, and I think it offers great opportunity to divert your hard-earned savings money into more productive use and achieve your financial goals in medium term.
Okay, since we're talking about fixed income strategies, right? We do have a segment on our show, Rahul, every week where we give one financial health tip of the week. And since today's show is on investing in debt funds and fixed income, I thought let's talk about the health tip of the week, which is also about fixed income investing. So in case you've never invested in fixed income, here are 5 reasons why investing in a debt fund as part of your overall investment portfolio is a great strategy. 1, there's a low-cost structure. 2, you have stable returns, relatively stable returns. 3, high amount of liquidity. 4, there's reasonable safety. And 5, there's diversification away from equities. So the big question is, how do I pick a right debt fund? The first thing to do is check the average maturity of the fund's portfolio, as this has a bearing on your return. The lower the average maturity period, the lower is the fund's volatility and your returns. The second thing to do is make sure the fund's portfolio is reasonably liquid. A large percentage of corporate debt in the portfolio does not bode well in the short term, as it's relatively less liquid, corporate debt that is. The third thing to do is avoid schemes with small corpuses. That's because the funds do not disclose if there are any investors who own a substantial chunk of outstanding units. If there are such investors and they decide to redeem their holdings, then the fund could be forced to sell their holdings below the market rate. And fourth, the best tool to capture the interest rate sensitivity of a debt fund is modified duration. It tells you how much the price of a bond would move if interest rates move up or down by 1%. The higher the modified duration, the greater will be the impact of an interest rate change. So these are just certain, tools that you can use to pick the right debt fund. Rahul, come in on this. Anything that I missed out in terms of, what are the do's and don'ts while picking out debt funds?
So apart from that, you can also should be mindful of the more than maturity. I think the modified duration or the Macaulay duration, what the SEBI asks us, the mutual funds to disclose. And it is, it's available, say, on every 15-day basis. The whole portfolio and the portfolio details are available for all the mutual fund schemes, for the debt funds every 15 days. And apart from that, I think more or less you have covered, but the credit quality of the portfolio also has to be kept in mind, and one should be aware of what they are investing into. There are more than adequate disclosures being done in line with the requirement of the regulator, where the regulator has done a great job in, making the portfolio disclosures much more clearer and, straight to the investors, so that there is less ambiguity to the investors and easy to understand. Apart from that, we firmly believe that mutual funds offer a great flexibility in terms of liquidity, diversification, and the risk control measures that one should exercise in investing, and that's what it is.
Okay, and those are the reasons to invest in debt funds. It's flashing for you on your screen, and the ways to pick a good debt fund. You spoke about credit quality, right? I just had a follow-up over there, Rahul. For an average layman investor, how does one check on the credit quality of the paper that the debt fund is investing in?
Yeah, so in Indian parlance, if you see the rating instruments have all the instruments have a rating, and they have been disclosed in the fact sheet, and the overall credit profile of the portfolio is also disclosed on the fact sheet, and the information is given on every 15-day basis. Apart from that, they can also consult any of the funds directly, or their trusted investment advisors. But they should primarily understand that AAA offers the highest possible safety in the debt instruments. AA is high safety, and then unless the risk reward is commensurate, funds typically do not invest below AA unless risk reward is hugely favorable to them. But yeah, these are the broad parameters. Apart from that, funds invest majorly into the sovereign bonds, which include the securities issued by the Honorable Government of India, as well as the various state governments. They are absolutely safe securities as far as the credit is concerned. Obviously, they do come with their own set of interest rate risk, and that the fund manager is expected to maneuver and keep the decision making in a way that suits the investor expectation and in line with the investment objective of the scheme.
Okay, Rahul, it was a masterclass that is much needed, right? A lot of basics is what we spoke about, but sometimes you need these basics to remember how to best maximize your portfolio. And thanks a lot for joining us on CNBC TV18. We've run out of time, but not out of topics. Keep writing to us. We love receiving feedback from you. Until we meet again, have a great weekend, and thanks a lot for watching.